Now, somewhere in America, a family is sitting at a kitchen table after the kids fall asleep, doing math they don't want anyone to see. The mortgage payment they signed for 3 years ago is somehow hundreds of dollars higher today. The cushion they thought they had is gone. And the letter sitting unopened on the counter, it has the word default on it. This isn't a story about reckless borrowers. This isn't a story about people who bought mansions they couldn't afford. This is a story about working families, veterans, single parents, people who did everything right and still found themselves running out of time. Foreclosure is rising again, and most people won't see it coming until it's already at their door.
The numbers don't lie anymore. In the first quarter of 2026, nearly 119,000 U.S. properties had foreclosure filings. That includes default notices, scheduled auctions, and bank repossessions. March alone saw almost 46,000 filings, up 18% from the month before and 28% higher than a year earlier. That's not a rounding error. That's a warning flare being fired in broad daylight. The pipeline underneath those numbers tells an even darker story. Over 82,000 properties started the foreclosure process in just 3 months. Texas had more than 10,600 starts. Florida crossed 10,000. California was near 8,000. Georgia, New York, each adding thousands more. These aren't abstract numbers on a spreadsheet. They are driveways, bedrooms, school routes, neighborhoods where someone is quietly falling behind, hoping nobody notices yet. In smaller cities, the pressure is even sharper. Lakeland, Florida had 1 foreclosure filing for every 409 housing units. Columbia, South Carolina had 1 for every 440. In those markets, the crisis isn't creeping, it's accelerating. And here's the number that should scare everyone the most. In March 2026 alone, lenders repossessed more than 5,200 homes. That's up 42% from March of the previous year. Repossessions aren't warning signs. They're the finish line. The house is gone. The family is out. The damage is done. But how did so many people who thought they were safe end up here? The answer is hiding in something most homeowners never thought to question.
The lie inside the fixed mortgage. Here's what the mortgage salesman didn't say at closing. A fixed-rate mortgage freezes your principal and interest. It does not freeze what it actually costs to own a home. Property taxes can rise. And after the pandemic housing boom sent values soaring across the country, local assessments followed. A house bought at $250,000 might now be assessed at $330,000 or even $400,000. At just a 1.2% tax rate, that's thousands of extra dollars a year, absorbed silently into an escrow account the homeowner barely understood. Home insurance has become its own crisis. Rebuilding costs surged during the inflation wave. Wildfire risk, flooding, insurer pullbacks, premiums that once ran $1,600 a year are now hitting $2,800, $3,500, or higher in many states. That cost enters escrow. And suddenly, the mortgage payment the family planned their entire budget around is no longer the number on the contract. Then comes the escrow shortage letter. This is where people's jaws drop. If the mortgage servicer underestimated last year's taxes and insurance, the homeowner now owes a shortage. Instead of paying it all at once, the servicer quietly spreads it over the next 12 months. And at the same time, the new higher insurance and tax estimates get built into next year's payment too. One escrow letter can produce a $300, $400, even $500 monthly jump with zero change to the loan itself. A couple that qualified for a $1,700 payment might now be staring. The math that breaks families. A family brings home $5,500 a month after taxes. Mortgage, $2,200. Cars, $700. Food, $900. Utilities, $350. Insurance, minimum payments, phones, school costs, the rest follows. What's left over is maybe $400 or $500 at the end of the month, if nothing unexpected happens. Now, the escrow letter adds $380. The grocery bill is up. The car insurance renewed higher. A credit card minimum crept up. Suddenly, that family isn't ahead anymore. They're behind. And behind on a mortgage is not like behind on a credit card. One missed payment feels like a mistake. Two starts to feel like a spiral. By the third, the language changes. Late fees appear. Letters get formal. Phone calls start coming from numbers they don't recognize. Words start appearing they've never had to understand before. Default, acceleration, reinstatement, loss mitigation, trustee sale. A $2,000 mortgage missed for 3 months doesn't turn into $6,000. Add late fees, escrow shortages, attorney costs.
The clock is the enemy. Most homeowners in foreclosure believe they have more time than they do. The national average foreclosure timeline sounds reassuring, around 577 days in early 2026. But averages are a trap. Louisiana takes over 3,000 days. Hawaii and New York can stretch beyond 1,900. Those states drag the average way up. Meanwhile, Texas averages roughly 165 days. West Virginia, Alaska, Wyoming, all under 200. In those states, the calendar isn't generous. It's ruthless. In Texas, foreclosure sales happen on the first Tuesday of the month. Once a home is scheduled at public auction, it's not a vague threat anymore. It's a date. Strangers can show up and bid on the house while the family inside is still trying to understand how they got there. Early in the process, options exist. Repayment plans, loan modifications, forbearance, working with a HUD-approved housing counselor. Not all of them lead somewhere, but they exist. Later, doors close. Documents that arrive too late mean more. A denied modification with 2 weeks left before auction leaves almost no room to maneuver. And after the auction, the conversation changes completely. It's no longer about saving the house. It becomes about when the family has to leave, what happens to their credit, and where everyone sleeps next. Foreclosure is not one event. It is a narrowing hallway. At the beginning, there are several doors. Every month of silence, another one closes.
Predators in the driveway. When foreclosure filings become public, and they do become public, the family's crisis becomes visible to people scanning for opportunity. Investors, wholesalers, and outright scammers all track default notices and auction schedules. The pitch usually sounds kind. We can stop the foreclosure. We'll take over the payments. You won't ruin your credit. Sign here and we'll handle the bank. For someone who hasn't slept properly in months, those words feel like rescue. Some of these deals involve signing over the deed while the mortgage stays in the original homeowner's name. The investor controls the property. The original borrower is still legally tied to the loan. If the investor stops making payments, and many do, the foreclosure damage still lands on the person who thought they'd been rescued. Other scams charge upfront fees for mortgage relief that never comes. Some tell homeowners to stop communicating with their lender entirely, which destroys any chance at a real workout. A few pressure signatures under a countdown, warning that lawyers or housing counselors will ruin the deal. Real help doesn't require secret.
After the keys are gone, losing the house is not the end. In many ways, it's the beginning of a longer punishment. A foreclosure can stay on a credit report for up to 7 years. The score drop can be 100 points or more, sometimes significantly higher depending on the credit profile. Renting becomes harder at the exact moment the family needs housing most. Landlords check credit, deposits go higher, options narrow. Buying again is off the table for years. FHA loans typically require a 3-year wait after foreclosure. Conventional loans can require up to 7. For a family that spent years trying to plant roots, that timeline feels like exile. Children change schools, commutes grow longer, the backyard disappears. A family that once had a fixed address and stability may suddenly be competing in a rental market that's already too expensive. And the damage spreads beyond one house.
Vacant homes weaken nearby property values. Blocks with multiple foreclosures start to feel different. Neighbors who are still paying begin wondering whether they're next. At the end of 2025, roughly 1.1 million homeowners were already underwater, and 3.2 million had less than 10% equity. For them, even selling might not be enough to walk away clean. The American dream was built on the idea that owning a home creates security. That promise is breaking, not in one dramatic collapse, but one escrow notice, one missed payment, one auction date at a time. The foreclosure wave of 2026 won't announce itself. It will look like a quiet driveway, a family packing boxes before sunrise, an unopened letter on a kitchen table. And by the time the country fully notices, millions of homeowners may already be out of options. The most